I would give you a few tips over here about investing. You have to assume that in the worst case, I might lose out on all the amount of money or the corpus of money which I am putting into the stock market. Now, when you are ready to take that kind of a risk, invariably you will land to few opportunities which will give you a disproportionate gain. So my bet would be, try to invest in 2-3 companies in every 6 months, and do not take out your money after suffering few losses. Try to keep invested in the stock market for good amount of time and set your targets before investing. So let us say you're investing on a company A. So your target set is that I want to gain 30% from this company in 1 year. Let us say in 2 days the company rises by 30%. You should not be greedy, just take out that money. And let's say your target was that I will be achieving either minus 5% of loss in this company or 30% of gain in 2 years. So in the 2 year time frame, whenever the company goes below minus 5%, you have to sell, or whenever the company goes above 30%, you have to sell. So try to keep a lower bound, upper bound for your investment criteria for every stock. And once you do that, you will always become a rule based investor or a trader, and then it won't be difficult for you to get over your behavioral tendencies. Because see, stock market investing is easy, but it is the people who invest who make it difficult, and it is the behavioral aspects of a person which makes investing quite difficult in nature. Because the idea here is that a part of it is an art, it's not very hard science. So you need to know how to master this art of investing. The science of it is pretty much clear. You analyze the financial statements, you go to the website of the company, you try to find out whatever you can find about the company, and based on that knowledge you invest your money in the company. But the thing here is, when to exit from the market. That's a very important question which people don't really address. So that exit point is decided by your behavioral tendencies. So I would suggest you to read a bit of economics, bit of behavioral finance, bit of psychology, bit of investment behaviors, and then try to understand how to get over this, and how can you master your skills in investing. So whenever you invest in any company, try to first look out for P by E ratios. When you look out for P by E ratios, what happens is that whichever company has a higher P by E ratio than the peer. When I say peer, let's say you're trying to invest in an IT company, and you see that supposedly a company X has a P by E ratio 2 times of the average P by E ratio in that industry or subsector, then that company has some kind of an issue. Either it's a high growth company, people think that it will be a high growth company, or there's some kind of overpricing in the company, or there's some kind of manipulation in the company's share. So try to avoid such companies which have more P by E ratio than their peers. Now the second point is, try to look for companies which give predictable dividend. See, if a company is giving you a predictable dividend, you can earn money without even exiting or getting entered into the market. So keep invested in a company which is giving you a consistent dividend. There's a downside to that dividend companies, but still the downside is not that great, because if you are getting money on a regular basis, you also get appreciation from the stock market and also get the dividend income. So try to find companies which are reasonable in P by E ratio and give a good consistent dividend. So dividend yield is one criteria. Then you can think of their debt. If their debt, the current debt, you can find that in balance sheet. If the current debt is of the same order as their current cash, that can also be found in balance sheet, then that company has a reasonable health. And also try to look for their EBITDA. if their EBITDA and their profit are very different from each other, are of like half of each other, then you need to see why the EBITDA is so different than the net profit. So there are many rules like that. Once you start searching how to invest, and then you can go down the rabbit hole of investing. But the idea here is that you need to learn continuously, or else you will keep finding this as a gamble.